Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another velocity banking review. So, what is velocity banking? All it is a debt payoff strategy where you throw all of your money into debt with the help of something called a line of credit. So, in order to do velocity banking, it's really easy. First step is just doing a budget, right? So, you know what really surprises me? A lot of people really struggle with budgeting, right? Amount of income coming in, expenses, and then you just in your expense breakdown, you list every single debt that you have. And then the hardest thing, in my opinion, would be figuring out this number, which is all your general expenses, meaning your expenses that are not tied to debt, like your food, gas, insurance. You always have to pay for that every single month, right? And so once you've done your budget, then the next thing you need is something called a line of credit. So if you don't know what a line of credit is, a credit card is a type of line of credit. So all it is just a financial tool where you could borrow money, pay back, and then use it over and over again. Um, I have over 20 credit cards, I think. I can't remember, but I think I have 29 lines of credit. So, credit cards are the most popular line of credit, but there's home equity, personal, business lines of credit. A business line of credit is pretty much like a personal line of credit, except you're using it for your business. But the cool thing about the home equity or personal or business lines of credit, for the most part, is that you can use it to pay anything. Again, I always like to show off my home equity line of credit where I click a button and then it dumps up to $280,000 in my checking account at a 7.5% interest rate. And we're going to use this, okay, for debt consolidation, increasing cash flow, ultimate flexibility. Because when you make your line of credit as your main operating account, you never have to worry about doing the thing that banks want you to do. And what is that thing? It's called saving money, right? So you look at my bank account right here, there's no money saved. I have absolutely no money saved. It's at zero, right? It's at zero, no money saved. And because we're just throwing it all into debt. And, if you want to know what velocity banking truly is, okay, it's just not saving money rebranded. That's really what it is. And people are like, you know, saying this is a scam, but how is not saving money a scam? And then you just use a line of credit to make it easy for you to not save money. Okay. So let's go ahead and change the flow of money. That's what we call it. Because what do we mean? What's the difference between here and here? Well, the income is the same, right? We're not increasing our income. And if you ask most people, like, hey, you make 6,500, your expenses are 6,400, and your savings are 86. Do you need more money to get yourself out of this hole? Everybody will say yes. Pretty much everybody. But what if you had something called a line of credit? A line of credit. Okay. We'll say that we have an access to maybe like an $80,000 line of credit. $80,000. Similar to the this one right here, but without the two in the front, right? So let's assume we have access to it. Now, here's the thing. How do you get these lines of credit? A lot of people don't understand this because, on to be honest, the bank doesn't want to teach you this. But banks don't lend money to people who need it, right? So I just got the credit when I don't need it. Like you ask yourself, you wake up, do you need money today? If the answer is yes, you'll get denied, right? That's really important to understand. Excuse me there, I had to pause for 1 second, and then now let's resume. Okay, so $80,000 line of credit, okay? And a lot of people, when they see this, they're like, "Well, you need to make more money, $85, that's not enough." But, like, how are you gonna increase this number that was originally 85 and then it would, um, and not save money, right? Like, that's ridiculous. A lot of people, eh, they love saving money. They love saving money, even if they don't even save money. That's the weird part. Ask most people, like, "Hey, do you think it's a good idea to not save money?" Even if they're broke, they go, "Oh, yeah, yeah, you should save money." I've asked ChatGPT this, like, why is it that when you don't save money or tell other people you don't save money, the person you're likely talking to is broke. They freak out that you don't save money, even though they don't save money, right? You ever notice that? Anyways, all right, so let's go ahead and assume we have an $80,000 line of credit at 8%. And here's the easiest way to figure out what the way how to move money into the line of credit. Use something called the cash flow index, right? Cash flow index. Okay. All it is a formula of the balance of the debt divided by the minimum monthly payment. So 5,000 divided by 175, right? Oh, is it divided by one? Oh, 500. Okay, 175. Did I screw up? I thought I put an extra zero. Zero? Okay, there we go. All right, this is 30,000 divided by 1050, and then this one is 35,000 divided by 1137.5. And then I have these cash flow index kind of calculated here, okay? And then let me just kind of go here, all right? And I'm gonna do this. And so you can kind of think of this as a ranking system, right? So what does this mean? All this means is that the lower the number, you get more bang for your buck in paying off the debt, right? So in terms of cash flow. So for example, would I want only pay so if I pay this $35,000 off, I get about $1,000 back or $1,100 back in my cash flow. If I pay the $250,000 mortgage, I only get about the same in cash flow. So it's not worth it for me to pay off this one, at least not yet. I got to pay off the other ones and then tackle on the other debts, right? So it's like a debt payoff ranking in order, okay? So let's go ahead and start off with these three, these low ranking ones, and then move them into the line of credit. So how much is that? 5, 30, 35. I think that's like 70,000. And 70,000 right here, 70000. And then once we moved at 70,000, okay, then these payments just go away. And it's like, whoa, your line of credit set you free, right? How did you go from $85 to $2,448.49? Your line of credit just set you free. You wish you had a line of credit. You wish you did, but you don't because you only try to get it when you need the money. And banks don't lend money to people who need it. So, I'm sorry, they don't, right? Right? You ever try to get drive without insurance and then try to get car insurance right after you crash the car? That's what how a bank sees you when you're like this and you need money and you try to get a line of credit. They're like, no way. You just crashed a car and you didn't have car insurance. You're a big risk. You only get the car insurance before you start driving, right? That's why it's the same thing with lines of credit. You get the line of credit before you ever need the money, okay? Because banks don't lend money to people who need it. All right, so let's go ahead and I don't even know where I'm at. Oh yeah, well, all right. Final steps is that we put our entire paycheck into the line of credit, we take our expenses out, and then after every single month, our cash flow will be used to reduce the balance of the debt. So let's go ahead and do this, and then do this, and then minus, what's our cash flow? 2448.49. And then what we're going to do is take the average daily balance, multiply it by the interest rate, 0.08, and then divide by 12, right? And then we're going to copy and paste here, right? Copy and paste, okay? And then in 32 months, okay, so 32 months, we're good. We paid off the 3 credit cards. So that's 70K, okay? 32 months. And then now we go on to the next ones, right? Now, the thing about amortized loans, because of the way that the formula works, is that it's the balance divided by the monthly payment. Unlike a credit card where the monthly payment is variable, right? The amortized loans, the monthly payment is fixed, okay? It's usually fixed. And so what will happen is these cash flow indexes will change over time as well. And so if I just type in 32, 32, 32, right, you'll see that this is the original, this is the current, and it's telling me which one to pay off. So I'm going to pay off this 10 grand to get the 386 rather than 27 grand to get the 371, right? So now let's go ahead and move this. This is the loan calculator right here, 32 grand. Move that, plus 10322.52 And then this is going to be 0, and I am going to increase this cash flow. I mean, think about it. What if you didn't have a line of credit and you had to save money? Your life would be so hard, right? Like, this was your savior at this moment, but the sad part is that you wouldn't have gotten it because the bank doesn't want to lend it to you there. All right. All right. So now this is going to be 2835.23. All right. And then now this is 36 months. 36 months. All right. We got that. We got that covered. Okay. All right. So now we got this here. And then 36 months. And then it's going to be 91K, 91K. And then now let's go to 36 months. So this is 0, just 36, 36. And then right, we're gonna use something. So if the loan balance is big and you got a relatively high cash flow index, and there's an interest rate difference, okay, like 3 to 8 or 4 to 8, best thing to do is use something called the chunking method, which is that you're just gonna move a piece of the loan into the line of credit. Okay, so let me open up the velocity banking calculator here. Give me one moment. All right, so we got it. We just gotta type in the numbers, the details, and I don't even know. All right, so now let's go ahead and type in the information, which is $35,000, and that's a 10-year student loan at a 5% interest rate, and the payment amount is 371.23 right here, 371.23. And then what's the current balance? It is 26265.15. 26265.15. And then what's the monthly income? I don't even know what the monthly income is. Oh, it's right here. 6,500. And then what's the living expenses? It is everything except for the loan we're trying to pay off. So that's going to be right here. 3293.54. 3293. All right. 0.7 years. Now, a lot of people get focused on like this chunking amount. So let's say I change it to 6,500, right? You'll notice, wait, did it go up a little bit? I think it did. Like, you'll notice it's practically the same, right? Like, too many people get focused on this. Like, oh my goodness, just do a small amount. But what's really more important is the debt payoff order. If I do this wrong and pay off, let's say, my mortgage first, I'm probably going to struggle a lot more than I have to, right? All right, so let's go ahead and do this 0.7 years. So 36 plus 0.7 times 12, it's 45 months. It's 45 plus 35. So that will be, no, wait, 91 plus 35. 126K. And then now this is 0. And then we see in 45 months, what is the balance of the loan? 0, 45, 232,000. 200, right? So this is 250. So now I just got to redo this, right? So with the 30-year mortgage, originally 250. And then what's the interest rate? It is 4%. And then the current balance is 232,543.27. 232,543.27. And then the payment amount is 1193.54. Okay. And then I think the expenses is 2,100, right? 2,100. Everything except for the loan you're trying to pay off. And then you see right here, whoa, 4.9 years. Paying off a mortgage is 4.9 years. I know that's impressive to some of you, but to me, I am very disappointed. Very, very disappointed. 4 point, I don't even know. Oh, I know why I'm disappointed, because I can't remember anymore, because I've paid off my mortgage in 2 years and 9 months. And, I'm pretty sure some of you are like, can't believe it, especially if you heard it for the first time. I don't even believe it either. That's why I don't even tell anybody anymore. Like, You ever hear the saying, like, if you chop down a tree in a forest and nobody's there to hear it, like, did it really happen? Well, that's kinda like this too. Like, I tell other people, they just kinda blankly stare at me for a moment and then realize what I said is true and then don't ask questions. And they're like, "Wow, didn't know that was gonna happen." Right? So, yeah, this is almost impressive, but what's even more impressive is 2 years and 9 months, and that's why I'm the GOAT of that payoff according to ChatGPT. Okay, so I'm gonna do 0 right here, and then now how long was it? It's 4.9 years, so equals 4.9 divided by 12, no, time plus 45 divided by 12. So it's 8.65 years. We are debt free. Debt free. 8.65 years. All right. Okay. All right. Well, that's it for today, folks. Another beautiful session of Velocity Banking. And by the way, before I end today, quick plug, if you're interested in not only learning about Velocity Banking, but a few other things, click the Google form link below. Other than that, because this is where I got this from Renatus, so I do resell. I'm an independent contractor marketer of Renatus, and if you do want to learn, again, I don't guarantee anything. If you do want to learn, click the Google form link below. Other than that, have a great day, and I'll see you all in the next video.